All right. Welcome in, everybody. I don't know why you can't see me, but I hope you can hear me okay. Welcome to our, the first AI Circle of September. Pretty sure I said the exact same thing last time, but this year is absolutely flying by. I hope everyone's had a good summer. I hope you enjoyed Labor Day a few days ago. And we're going to get right into the AI Circle here in a minute. Honestly, not a ton to go over today, but this could be a good day to get extra questions answered if you guys have anything on your mind. And with that being said, I am just going to get the disclaimer out of the way. There you go. Now you can see me. And then we'll get Kelly in here. We'll get some screen share going and all of that. So iFlip Investor Inc. and iFlip Financial Services are not financial advisors and do not make, buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure the iFlip Smartfolios that you select are suitable for your investment profile before trading in a live brokerage account. With all that being said, Kelly, can you hear me okay?
Perfectly.
Awesome. How are you today?
Tired and so far it's only Wednesday, but it seems like it's a long week, even though I've only been working for 2 days.
I was going to say, even though it's a short week,
Right.
I hear you there.
It feels like Labor Day was not the holiday I hoped it to be. But I hope it was for everyone that might be listening tonight.
Yeah.
Or this afternoon.
Absolutely. And just on the screen, the typical agenda in case this is someone's first time joining us tonight, we'll do a little market update. I don't know, maybe 10, 15 minutes or so, talk about the AI and Smartfolios that you guys want. And then a lot of people are here to get questions answered or just hear insight from one or both of us. So happy to have you guys here tonight. And I think we'll get Kelly's screen share going here in just a minute.
It should be there.
Yeah, I just have to turn it on. All right, there we go. I can see you now. Let me take the other one away. All right, and then I'm going to
take the other one.
Yep. Give me
take it all away from me.
It's here. They switched some stuff on me, and I'm trying to remember how I did it a couple weeks ago. That's all right. I wanted to move you from from the right corner to the left, but that's all right. Go ahead if you want.
All right, everyone. Well, let's try to get into it. As I have been saying for at least 2 months, that the market is melting up, and it continues to do so. It's a well-described rally that we all kind of anticipated. Most people out there with most of your accounts have probably done pretty well, depending on what things you took. The Dow, the S&P, here's the Dow, almost on its high. The S&P right here, literally 0.5% off its high, like the Dow. And here's the Nasdaq, same thing, not even 0.5% off its high. So call it, the market is on its highs. Yesterday, as you could see, there was, if you can look closely, there was a large dip in the market early on in the morning, but market closed on its highs and then had a follow-through rally today. And so what is a melt-up market? So it's maybe have a better description of it. A market that's melting up is doing so because there's no news to be able to say to do anything different than go higher. And so what we're having is a market that has no real information. If you notice the news cycles, there's nothing new coming out. It's the same old lawfare against Trump. It's the same old earnings reports. It's the same old information that we continue to hear during the summer. This is a very common practice during most summers as the markets are just, as people go away, the markets are looking for some kind of driving information, and almost never does that driving information come during the summer. It's just a time for peace, and we're getting it, and the markets are melting up. Let's take a look here even at the bond market. Notice here, this is kind of a little bit interesting. Bond market futures 10-year note is on its highs. That means interest rates are kind of closer to the lows, about 4.2% on the 10-year note right now. But what was interesting today on the Nasdaq rally is this. Look at the technologies. We have Apple breaking out of a flag formation that we saw right here that occurred over the last through most of August, and it broke out to the upside. Generally, this means this market is going to advance much higher. This is also true of Google. Look at this. Google almost up 10% on the day, and brand new highs by a margin of about 10%. It was on its highs yesterday. And so we're up 10% from there. Meta, some of these stocks are just off their highs. Netflix more notably off its highs, but it's probably going to just grind itself higher. So when you look at the Mag 7, these 7 stocks right here, you can see in their totality, these markets really do want to kind of move higher. And if they do, and that fulfills itself, the Nasdaq, of course, will make new highs, and we will just continue to melt higher. The technology rally, I will admit, over the first 3 months of the year, it made sense to me. It didn't do anything, but then finally, after the tariff issues that kind of culminated in early April, the market has just kind of resumed itself and made a very strong rally. Energy markets, they're basically just hanging in there. I mean, I think it's kind of notable that ExxonMobil is, which whatever dividend is paying now, still around 5.5 or so, is sitting in this range, even though look at the price of oil itself. Look at how Exxon has stayed right here all the way back through the fourth quarter of 2024. It's basically the same price, but look at oil. I mean, if we go back to the fourth quarter of 2024, it was at 90 a barrel. We have lost 1/3 of its value in the price of oil. We have seen prices come down at the pump, but somehow ExxonMobil is hanging in there extremely well. And look at the XLE, kind of the same thing. The things that have not held up are my favorites. They've kind of migrated from the highs of 2020 of $21 a share each almost to relegated down in this area. And now they are starting to level off in here. The great thing about these stocks, again, Energy Transfer and All Plains still remains this, the 8% dividend. It's just so hard to get away from something that's paying 38 cents a quarter on a $17.50 stock. It's just hard not to own it. It represents better, in my mind, I feel it's a little stronger than a 4% T-bill. So because it has twice the yield and not that much more volatility. That's if it just stays pat and doesn't move. Let's look a little further into the market. We've already seen the top 3, the Dow, the S&P, and the Nasdaq. Let's take a look at some of the banking stocks here. I like to keep an eye on these. The banking sector has done great this year as well. Look at JP Morgan. Don't need to say it. At the beginning of the year, we were around 238. We're now 300 almost a share. That's a nice little increase of over 22%. Bank of America, a similar story. Not quite as strong, but it came in around 44. It's at 50, so it's up $6, about 15%. Goldman, again, not quite the same story, but still good. It's up almost $170 a share. Again, a similar 22% increase. This is my sleeper, the FMNJ, Fannie Mae J. It's a type of Fannie Mae ownership. And these are the stocks that just kind of are grinding higher. It's only a $15 stock. Hopefully some of you guys owned it at a much cheaper rate where we bought it, which was around $5 a share, even before this jump. So that's one of the things we look at. Let's look at a little broader range of stocks. I follow this stock, Chef. Chef is kind of an idea of a company like Cisco that supplies restaurants. And Chef is just done well again in 2025, despite the restaurant industry not doing well. CrowdStrike, great stock. However, it's just pulling off of its highs. What is it? It's the company that does internet security. It's very broad based, and it's fallen off its highs of around 500 a share to 413. So it's down about 17% or so. But is this a good stock? Yes, you want to own it. This to me is buying the dip. By the way, it's also on a 200-day moving average. I always look at things when they're on that average. That's why I show it all the time. Carnival Cruise Lines, again, interesting story for the year. It's up nicely on the year, maybe 30%. But I don't look at this as a wide holding. Some of you do own this in some of our Smartfolios. Let's look at Landbridge. This is a stock that I was very high on. I remain bullish on the stock. However, it has not behaved as anticipated this year. Yes, we're down just a little bit on the year from around 63 coming in. We're at 53, so we're down about 12, 14%. I'm disappointed in this action. However, let's see what the fourth quarter brings. That's right around the corner. The same thing is true if I go to Texas Pacific Oil. It looked like we were having a little bowl pattern in here. Bowl patterns, Edwards and McGee classical, where you see it bowls out and then it explodes higher to fulfill the other side of a cup. But talking about the technical term, yesterday the Texas Pacific traded literally as high as 965, almost 970 or so. And today it pulled off of its highs. Somebody's a seller up there. And then today it tried to rally a little bit on the open, but guess what? It fell 3.5%. Lack of liquidity does that. The ownership is there, but the sellers are there when they see their little opportunities, which they had one yesterday. That's why they took advantage of it. Those that wanted out, they got out. I still feel very bullish on this. This one here has been a little more of the same disappointment. Came into the year around 1150. And we're now at 900. So we've lost 250. So we're down over 20% on that just in the year. Our old highs are here, are literally almost $1,800 a share. So that's literally almost half the price it was before Christmas of last year. And I like the stock. I wanted this stock to go from around 1,100 back to the highs. Now it looks like we're going to have to do it from around 900. Let's see if we can do it. I think we can. Tesla, again, weird move. Elon is back out of the White House, and it looks like in the hen house because he is sitting on his 200-day moving average, and it just doesn't seem to want to get away from it one way or the other. Again, it's a good stock run by obviously a brilliant man, but where do we go from here? My instinct is, even though the market melts up, we need more of a reason to own Tesla. I'm a buyer of it, but I'm not going to buy any more of it. And so I'm not looking to make next dollars in this stock. Let's keep a look at Walmart. Again, to me, this is a boring stock, but boring stocks tend to be a good thing to have in your portfolio. Stock looks like it's trying to recover off of a recent correction, bouncing off its 200-day moving average like it did before. Nothing much to say here. $100 a share. Is it a bargain? What's the upside? I don't know. I just keep an eye on it because it's a widely held stock. Might as well run over to a couple of the things I look at. Let's take a quick look at Hawaiian Electric. It's a stock I keep an eye on. I do own it, but I don't own much of it. It did look like it wants to break out. Some news came out with their earnings. It was okay, but not enough. So the market came literally from $13 all the way back down to 12, literally yesterday, 12. But that's actually a big move. And again, I'm still sanguine for higher highs here, but I don't have too much more information on Hawaiian Electric beyond the fact that technically it's a good pattern. This here is the electrical company that builds all the little fixtures that you see in your switches at your home or in an office. This is just a well-performing stock over the years. It's something you kind of own to keep in a portfolio. It pays a dividend, nothing special, but it's just a stock that shows if there's an expanding economy and growth building around the corner, stocks like this will perform. And look at the way this has performed since the tariffs. Again, from 58 to 111, it's almost doubled after the tariff wars in April. I mean, that's just phenomenal to see that. And out of a company you really wouldn't expect. All they do is make the little parts for electrical home electricity. Amazing. Keep an eye on another one is UPS. Why? UPS is 7.5% dividend. I like it, but look at the stock since COVID. Here's COVID down here. If you look historically, we can't go back further on this chart, but UPS is generally $100 a share. COVID, of course, changed the pricing of everything all around the world. It brought literally the $100 stock to double in price. And then since COVID, over the last 3.5 years, it has done nothing but go down. So the value of this stock, the value of this stock is nebulous, but you can't argue that it's at a historical price area and it's paying 7.5%. And it has done so for years. I look at this as a dividend play where the market is at its historical mean price after a huge decline. I think it's worth some ownership, especially given that yield. Let's switch around real quick. Let's take a quick look at Bitcoin and the crypto markets. Well, Bitcoin, from the last time we all talked, I'm going to make this chart much bigger to see. As everybody knows, just literally last month, we printed a new all-time high of around $123,000 a coin. We backed off to literally 108. There it is, 108, $108,000 a coin. Now we're at almost $112,000 a coin. Obviously, this is a market that most of you will agree, whether you understand it or not, has genuine, huge upside. It has been noticed recently in the news that Donald Trump, he owns more money in the crypto space now than he has in his real estate business over the decades of his lifetime. So for the 40 to 50 years that Donald Trump has owned real estate, he's made more money since he's been the president in crypto than his entire wealth that was amassed over his entire career. It shows you what the crypto space is. He's in it. I think the world has discovered it. Where does this go? I think as the rest of the world, and not all of the world, knows about current cryptocurrencies, and this is the granddaddy. I think, of course, and I've mentioned this before, I think crypto goes to a minimum of $250,000 a coin. Who knows if it can go to 500,000. This today looks expensive, even though it's a dip, but I think in the future it'll be looked at as a deal. And we may look back and say, oh, I remember when I could have bought coin at $110,000 a coin. And we don't want to be that, 5-10 years from now. So again, I encourage people, if they haven't looked at, really investigate this space and maybe own a little bit, just so that you understand its movement and the value that it may have in the future. Could bring you conceivably good wealth. So on that note today, Lee, I think I'll stop. I think, again, it's a boring market. We are melting higher, and I suspect we will continue to do that, even though this is September. So the last thing I guess I can leave on is we all kind of know that September and October are volatile months, September in particular. But in this particular case, I don't feel that this is a year that we have to worry about the September volatility. I think things look so boring. I think they're going to remain that way. And I think we'll have a surprise September, at least, where we don't have any huge dips and we actually continue to melt up. And so now I think I can leave on that note and see if there's any questions.
Perfect. And just back to something we talked about last time around, we talked about new portfolios and such. I believe you said the covered calls one might be ready here pretty soon. I'm not trying to pin you to a date or anything like that, but for anyone who's here last time, that should be the first one that's released.
Yeah. So everyone, here's the covered call. These are the things that are in it, but only one. I'm going to keep BITO and not the yield from the Bitcoin. So I'm looking at these 4 ETFs that will be put into a Smartfolio. And so what do they do? I mean, let's take a look at some of the pricing of it. I think I mentioned to everybody, this is part of the high yield money market, or sorry, high yield covered calls. And there'll be a new Smartfolio out there, and that'll be the name of it, high yield. What is it trying to do? We're going to try to capture on buy writing, something called a covered call, buy right. What is that? You buy the stock and you sell a out of the money call. If the market stays below that out of the money call, you earn the money that you sold the call for, and that becomes your yield. That's what a lot of people do. If they have decent money, they know how to do a covered call themselves. They buy stocks and they sell a call. The call becomes their income because you get the money when you sell a call. And then if the stock stays below the price, what they call the strike price, you keep your stock and you get the money. Whatever you sold the call for, when it expires worthless, you own that money. That is income. If the stock goes above the strike price and the market calls the stock away from you, that means, yes, they will take your stock. You will earn the money that you sold the call for. And generally, that means when you do that properly, you make a good profit on that trade, and then you rebuy back the stock. That is the concept of covered call or buy rights. Done properly, literally, smart traders can make about 1% a month doing that if they're wise and they can execute those trades. 1% a month means a lot of money when you have a decent sized portfolio. Most people with money will do that. Today, we don't have to have that expertise. You can use these ETFs, but there is a problem. When the markets go down, and I'll go into it quick, let's take a look at this is the triple Q yield covered call. Let's look at it. This was March, April. Remember? Look what happened. So if we bought this covered call, the QYLD, the Q yield, and we paid, say, a price of around 18. And by the way, I did. I bought this in January. I paid about $18 a share, but it is offering me a dividend on that $18 a share monthly of about 33 cents, almost 34 cents. So 34 cents times 12, right? I think you guys do the math, right? 30, 40, $4 a year on at that time, an $18 stock. Well, that is literally about 26% a year. Think of that, 26% a year. But wait a minute, if I hold it a year and I make the 26% on my money, say I put $1,000 in it, I lost the money from $18 to $16.66. So that means I have lost $3.50 a share. So therefore, I'm now, sorry, $16.60. I bought it at 18. My bad, $1.40. So I lost $1.40, but I made all those dividends since then. The dividends add up to more than the loss of the strike price. Well, that means I made money in aggregate. At the end of the day, it's an interesting play, and here's why we're doing it. At the end of the day, if I can make more money and hold these things long enough and they don't implode like they did here on that tariff war, and they just stay steady, we can make money in a very opportunistic way on a monthly basis. If we do this properly, we can actually, if we can ever get these things after they've gone through such a huge swoon, we're going to do very well. But in aggregate, my study showed that over the first 6 months of the year, January all the way through July, before we got paid July dividends, we were up 7.5% half a year. That's extrapolate that to 15% a year. That's not bad. That's owning all four of these five covered calls. They all have the same characteristics. So that portfolio is coming. I recommend that if people are interested in it, look at it for a small amount of money to take a look and see what high yield looks like. If it works for you, that may be something that you might want to think about to add to your portfolio if you're looking for yield and dividends. So that's why we built it.
And correct me if I'm wrong. I think maybe some people's brains will go to high yields and high yield savings account. This is not a conservative strategy, correct?
No, it is not a conservative strategy, but I wouldn't also say it's a risky strategy either. I would say it's kind of moderate to moderate minus, which means if you think of a good steak, you would say medium is what a lot of people like. Some people like medium rare plus, right below medium. This is what I consider this. If you're looking for 15% per year on your money, you know you're taking more risk. But it is not high yield in its normal sense. It's not a bond. It's covered calls. So these are covered calls on the triple Q, on the Russell. That's the RYLD. The QDTE is another. QTTE is another Nasdaq yield product. And then the BITO and the YBTC are the Bitcoin products. So the Bitcoin products even offer more. Here's the Bitcoin product BITO. It's trading at $19 or so right now, towards the lower end of its range. But look, it pays $1.20 a month, everyone. So what we're trying to do is take away some of the risk from the highest yield ones and throw it into the overall market ones, which are very deep markets, as is the crypto market. Yes, to quickly go back to your question, Lee, I would call it a moderate yield strategy, safer than high yield bonds. But remember that we will probably look at not buying these products for price appreciation. We are there simply for the yield.
Yep. I'm going to answer Dan's question first, or actually have you answer it first. Let me get over to the Q&A portion.
Yeah.
So, I mean, I would rephrase it maybe and just like, is it realistic to expect about 1% a month in that, in this new Smartfolio? Obviously, we're not trying to teach people how to trade options by any means, and Dan knows that. He knows plenty about what we do.
Okay. I'll answer, Dan, the best I can. Yeah. Is it something that could be automated through Flip? We're not going to automate it by actually trading the actual covered call. So to do a covered call, you have to buy the stock and own it for a client. Say I'm doing it for you, Dan. I would buy you 100 shares of triple Q and whatever that is, and then I would sell one call against it. When I sell that call against it, I'm physically putting an order in once a month to sell a call against that, some barely out of the money call. If you do that, yes, you can make about 1% a month. A lot of traders do this very thing, and that's how they make their money. They're options traders. They're doing things like that, covered calls, or they're doing other kinds of strategies as well. But can we automate it? Right now, to do the exact trade, no, we cannot. We don't offer options on our platform. However, in lieu of that, we can build this high yield CC, which is called covered calls, and we can own these 4 of these 5 ETFs, and we will be getting the same thing. These are professionally managed ETFs there's a person behind the scene that is actually doing the covered call writing. It's not automated inside these ETFs. It's not being done that way. So we are at the mercy of someone else putting on those trades. But generally, the people doing this are skilled and they have a formula and they follow the formula over time. So this will be our product that accomplishes what your question is asking.
Seems like a good bridge between the two. And I think this is from Jack. Jack, I'm sorry if that's not your name, but that's the first name that I saw there. He said, I understand covered calls. I understand there's a put version as well, but I can't wrap my head around how it works. Would love an explanation. I know this could get very into the weeds, and it's a little bit out of the scope of what we do, as you just kind of said. But for anyone else who's curious about options, and I guess I'll let you take it from there.
I'll do a quick 101 on calls versus puts. Calls, everybody understands when you buy something. When you buy something, you are making an anticipation that the price of it is going to go higher. So a call, and then we understand if it goes higher, we can sell it later and then make a profit. A call is just that as well. You buy a call, it means you're hoping that the stock you bought the call on is going to go higher, therefore increasing the value of your call. You sell the call and you make a profit. A put is the exact opposite. What's going on behind the scenes, though, it confuses most people. Mm-hmm. Remember, these are called options, are contracts. You have a contract with the person that owns the stock that they will give you the stock at the time you ask for it. If your strike price of your stock is lower than the price of the stock that they own, then they have to give it to you. A put is another contract that says, look, if I buy a put, I'm expecting the market to go down. And what I'm doing is I'm forcing someone that owns the stock to sell their stock at a lower price sometime in the future so that I can make my profit on my put that I bought. Now, again, a put and a call are just a short and a long of the market. It's the same thing people have some trouble with when they understand what is going short the market, which means I'm selling a stock that I don't even own. I'm selling a stock I don't own. Hard for people to get their arms around that. But in the markets, you can do that. You're essentially making a contract, because remember, we never see the stocks we buy or sell. They're just things that sit electronically on our platforms. But when you sell a stock and you don't own it, you are short the stock. You're expecting it to go down. What happened behind the scenes? Some guy said, okay, I will sell you the stock at a cheaper price later if you're right and the price goes down. And they will sell that stock to you at the lower price, which means you're going to make the difference between the price it is today and the lower price it is, hopefully, tomorrow, if you're right. And you're forcing someone to lose money on their ownership of the stock because they allowed you to buy the put from them. That's how it works. It's a matriculation or a complexity of the way the markets work. But at the end of the day, you remember, you can make money when the stocks go up, and you can also make the same amount of money if the markets go down. It's just the opposite of buying is selling. And so we all must accept the consequence that we can sell things that we don't own as long as we made a legal contract to do that. And so when you open up your accounts and you say, I want option trading, you are actually, when you look at the language in your options agreements, you'll see, hey, this is saying this is what's going to happen. And they're informing you, this is why you will make money or lose money if you're in these markets, correctly or incorrectly. And so that's what those contracts, option agreements are, is for you to understand. That's what's going on in the background.
Yep. And just to be clear on the options or the legal jargon and all that, that would obviously be at other places, not with us. There's nothing referring to options in our terms and conditions because we really don't do them. I think that those are two good answers. Everyone seems pleased with them. I don't see any other questions, so I'll do a final. Yeah, I'll do a final call for questions in case there's anything out there. In the meantime, we will be back in a couple of weeks. So our next AI Circle is scheduled for the 17th. So next week off, we'll be back in 2. And then I believe that puts the following one in October for the 1st of October. But we will announce that next time like we always do. I'll give YouTube a second to catch up. I see Jack said thank you. So no problem. Also, Dan. Yeah, we kind of anticipated a little bit shorter one today. Not a ton, like you had said, has really happened in the market. But as I think I said last time, that's not always a bad thing.
As long as it's making new highs and we're in the market, that's a good thing.
Yeah. All right. I think we're going to call it there. So everyone have a great rest of your afternoon/night, wherever you're listening to us from. And we will see you back here in a couple weeks.
All the best, everyone. Happy holidays. Happy Labor Day.
Bye-bye.